Hey Internet, it's RJ. Welcome back. Thanks for tuning into this show today. Now, today's episode, we're talking about the bank decision-making process. You know, you sit down, you fill out your application, and they decide within 30 seconds if you're getting a shiny new credit card or other financial products. But what actually goes into that decision-making process? How does it affect us, and what should we know? So, of course, if that sounds interesting to you, then go ahead, press the subscribe button, and let's get to work. Now, as always, we focus on credit cards here, but this is similar for the majority of lending products, and I will talk about some of them, primarily like mortgages. That's kind of like your more extreme one. And we'll use chapters tools, so if you are interested, you can hear a little bit about that at the end. But overall, what are we talking about? Well, you know, you sit down, you do a credit card application, takes 5 minutes, if that, probably closer to 2 or 3 if you've been doing this long enough. And then within 30 seconds, if you're lucky, you get that instant decision of, hey, you're approved for the card, here's your credit limit, here's your interest rate. And of course, they're doing that all by factors and information that you provide them in the application process. But how does that really work? Well, first of all, you could think of it as, if you take something like everyone's fan favorite, you know, a Chase card or what have you, you know, behind the scenes, you have underwriting, which granted, a lot of this is automated underwriting. That's how it happens so fast, because they're building out decision models to ingest your information that you give them and then kind of come up with a solution very fast. But underwriting still sits underneath risk management. And so what banks are really doing is they're making risk decisions when they're approving people for new accounts, credit limits, and interest rates, right? Because really lending is risk decisioning, right? And there's 3 factors that we'll cover, which is the approval, the credit limit you get, and the interest rate, right? So that's kind of how it works. So behind the scenes, you know, a Chase card, a custom cash, whatever, you know, they'll build out the underwriting guidelines or model for that product. So it would, you know, again, this is, you know, they're never going to show us this. So this is a loose example, if you will, but, you know, they say, hey, we're looking for FICO scores between this to this. We're looking for income from this to this, you know, credit history spanning this long, this many positive, negative marks, what have you. And the reason they build all that out is because they want to create a level of, you know, it being objective and just numbers based. I mean, the cool thing about math is it either is or isn't. 2 plus 2 is always going to be 4. It doesn't matter where you live or what color you are. And that's really what they're trying to avoid. They want to remove all of that, so it's best to have it just objective. And, you know, if an auditor comes, and an auditor would come and say, okay, show me all your approvals and all your denials, and then show me the underwriting guidelines for this product, and they'd marry it all up and say, well, yes, you can set the guidelines, but as long as you're setting them and using them fairly across the board, then, you know, we should be fine. Again, a high-level description of it, if you will. Now, of course, if you do get denied, you will get a letter that gives you a vague, generic reason. They care a lot less about telling you the reason. It's more so that they have to have it documented, again, for these auditors to come in. So, again, the highest level, that's kind of how it works on the back end. So when you apply, you're really going through like a decision engine, if you will, because lending, again, as we said, is pricing risk. So the first piece of the risk decision is, am I going to let you in? Am I going to approve you? Now, they use the word credit worthiness, right? I mean, it sounds a bit dramatic. We're not exactly pulling the sword from the stone here, but it sounds better than saying how much of a risk are you? So they swap in credit worthiness. How worthy of credit are you based on, you know, your FICO, your income, things like that. So, you know, in addition to the things we covered, like income, how much do you make, what's your FICO score, which will show some of your credit history and things like that, you know, they can also add in what I would refer to as overlays, which you hear more about in the mortgage space. But, you know, as an overlay would be like a rule that, you know, like a Chase 524. Like it's, you know, Chase's rule, but Bank of America doesn't have that, or Amex has a different rule, right? So Chase says, hey, if you've been approved for 5 or more credit cards in the past 24 months, we'll decline you. Amex, we're only going to give you 5 credit cards, or 4, depending on the day of the week and like who's talking about it, right? So they each add in their own other factors on top of the FICO, on top of the income, right? Whatever the bank feels comfortable for risk. Now, in addition to that, I would also say it's kind of evolved to look for profitability. So I can determine some things based on, you know, what I get from your credit information. If you've applied for a ton of accounts, you could be in need of credit, and I might say, nope, that's too risky. I don't want to extend you any credit. On the other hand, you could have a lot of accounts and not be using any of your credit. And I can say, well, you don't need any credit, so you might simply be here for the intro offer, and I can decline you because I don't think I'm going to make any money off of you. The city's done that to me and a few others, especially when they promote the city premiere a lot. for whatever reason, their denial reason was like too much of unused available credit or something like that. So they can add in other factors. Again, the goal here is just, objectivity, or be able to represent that to a lender. Now, let's say you get approved. Happy path, of course, the instant decision works. Sometimes you do have to go to a real person to take a look at the file. My last application, a U.S. Bank business leverage card, was not instant approval. Had to go to a person to review it, and you get an answer in a few days. Not the worst thing in the world, a little delayed gratification. But let's just say you got approved, so that's one risk decision down, letting you in. Now, the other two major decisions are how much am I going to give you and what's it going to cost you. So if we start with how much am I going to give you, we're talking about credit limit. And one of the more annoying things in this game is when you get approved, but you don't really get a high credit limit. This happens to the best of us. And, this happened to me on the U.S. Bank business leverage I just talked about. I have a Cash Plus card with U.S. Bank with maybe like a $14,000 limit. I have a U.S. Bank triple cash card with like a $10,000 limit or something. Business leverage, they gave me $3,000. Which is annoying only because the intro offer for that one at the time I did it was spend $7,500, and so I'm trying to make my property tax payments, and the property taxes are $3,200 and some change, plus the processing fee, which means I have to break it up into two different payments, which is just a minor inconvenience, I guess, but it's still kind of annoying. Of course, if it's your only credit card, then it is even more annoying. And so sometimes it doesn't really seem like there's a rhyme or reason to it. Overall, though, the lender can look at how much overall credit am I willing to extend you. So U.S. Bank could have said, well, I've extended you credit over here and over here. I don't want to give you much more, so I'll give you $3,000. That could play a factor into their decision. Additionally, they could look across their whole portfolio and say how much outstanding credit or available credit do we have out there right now, meaning that anytime someone has a revolving line of credit, like a credit card, there's still a risk that that person could use it, so they might count that as like, hey, we're potentially extended pretty far. Let's dial it back a little bit. If they're trying to encourage spending, they might offer more. Additionally, factors that they could look at is actual card portfolios. So a while back, we had the Chase Amazon almost breakup, right? And one of Amazon's biggest complaints was like, hey, look, you got to give people more credit limit. So Chase went back through and gave everyone additional credit limit. Well, not everyone, but a lot of people. I myself applied for a Sapphire Preferred, I think in April, and then 2 months later, I think in July, 3 months, I applied for an Amazon card. So the Sapphire Preferred, I got 20 grand on. Applied for the Amazon card, they gave me another 20 grand, which I thought was very surprising. In addition to that, so they could look at the portfolio and what agreements they have in place with their partner card, and kind of play around with their credit allocations. We're not necessarily going to know for sure how they determine and how they decide. But that is another factor of how much credit I want to extend you. And again, going off of what I have, I'm at least in the high 700s, for my scores. I haven't checked in a while. I can put one up for you. But sometimes it doesn't matter that you have a high score. It could just come down to how much credit they want to extend. What are they comfortable with? Answers that we'll never really have an answer to, but it's still a risk decision. I've also noticed that some banks like Citi will try you out as a brand new customer. I applied for a custom cash. They gave me $3 grand. And then, a few months later, I got the double cash and they're like, here's 10 grand, right? So, they could just be trying you out, building a history with you, extend a little bit of risk to get a new customer and what have you. But credit limit is definitely another way that they manage risk. Now, the other one is APR. Now, we don't get too much into APR here because we always say pay the balance in full, as we're obligated to say as a credit card channel. But, APR is basically, you could think of it as that's the financing charges or the cost. And really when they come up with this, you're talking about, again, market price plus risk. So you've got your interest rates that you see advertised that usually affect, short-term debt, goes as high as auto loans, basically, which are 5 years. So not super short-term. But again, credit cards, again, the rate is variable. So you'll see, they'll take the market rate basically and then price in risk. So risk factors are, again, what we've talked about, their FICO score, their how much you make, their your credit history. There could be other factors like how much they've extended. Again, we're not really going to know all the factors that go into it, but it's very much a risk decision. The bank kind of saying, okay, we lend you this much money, and then, we will make, if you don't pay it back, we will at least price in this much profit on our end, making it off of the money that we lent you. another way that they manage risk. Now, credit card APRs, they're generally so high anyways, so even if you've got stellar credit, it's still going to be, 10, 15%, something like that. Usually, there's not actually a limit, I don't believe, but usually they do stop in the 20s just so they're not, blamed for being egregious, but they could hike it as much as they wanted, I believe. So there's that. So bottom line, why does all this work? Well, again, as we kind of said, even though we say credit worthiness, no matter what, there is always a risk to, lending someone money because this is known as unsecured debt. Now, is it that much more risky than actual mortgage? I don't really know. I don't think so, but there's no collateral backing the credit card loan, so no one's going to come back for you for your sandwich if you don't pay the bill. So they're saying, yep, that's more risky. It's unsecured. I don't know what you're buying, so I can limit the credit limit. I can hike the APR, things like that to help manage risk. Now, again, credit cards are pretty simple and to the point. Auto loans, they can vary. It depends on where you go, but even most auto loans, they're just doing one credit pull from one agency. They're usually doing no proof of income, things like that. The same with credit cards. That's another reason why credit cards end up potentially being seen as a little more risky because they're usually not doing proof of income. They're just going off of stated income, which you're just telling them how much you make. So they know there's a perceived risk there because, you could be making it up. You could be just miscalculating. You could be being liberal with how much money you say you have reasonable access to. And the same with auto loans. I don't have to do proof of income or anything like that. But when you get into mortgages, that's really the big one for most people. And when you get into mortgages, they're doing what they call a tri-merge credit pull, which means they're pulling from all three different agencies, be TransUnion, Equifax, and Experian. And the reason being is, as we've talked about here before, no lender is required to report to any of the agencies. So the only real way to get a full picture, the best picture you can, is to pull from all three. But don't worry, you're nice enough to pay for it on their behalf. So they're really doing you a favor. In addition, with a mortgage, you've got proof of income, proof of employment. They call it VOE, VOI, where you're submitting pay stubs where, like, the day before you close, the lender has a department called Verification of Employment, VOE team, that's actually calling that HR person or your boss to make sure, hey, you're still employed. Because, again, they're talking about a lot of money, but funny enough, the loan amounts are so much, $200,000, $300,000, $500,000, and the interest rates are much lower than credit cards because, again, they're saying, hey, there's collateral behind this product, being the house, so if you don't pay, we can take it. Despite popular opinion, banks aren't actually really set up to take your house. It's actually a real pain to hold it in real estate owned, try to get it sold. And it's really not, they really don't want to because of the headache and the costs involved. But on the mortgage, the difference you'll see is, the underwriting guidelines. There's a real department of underwriters reviewing everything, bringing the home appraisal. They figure out what value supported and all that. So there's someone reviewing that. It could be one underwriter per house, or they could, have it split up in collateral underwriters, income underwriters, that whole thing. And then the bank will set, the guidelines primarily come from, Freddie and Fannie, the ones who are buying the majority of these loans. So they'll run your loan through something called Desktop Underwriter, or as a Loan Prospector is the other site. And they'll come back and they'll basically say, yep, if this loan meets these criteria, we are likely to buy it. And that's what they have to underwrite to. Now, in addition to that, just like 524 and Amex's credit card limit, a lender can come back over and say, well, I want to add in what they call overlays, which would be, for example, I only want to lend on so many percentage of this condo complex. And the reason you see it on condos is because condos are riskier because they're connected together. So if one goes up, knock on wood for our people in condos, then multiple are going to go up, or if something happens with the association, you'd be surprised. They abscond with the money, what have you. You own that, and that's the Bank of America condominium complex, right? So it's a lot of risk, so you might set an overlay like that. Whatever risk tolerances the bank has, because not to get too far into it, but the government has the power to the agencies to make you buy back a loan if it's not performing, or charge you for a loan that was misunderwritten but is still kind of performing. So you can see some things like that, but you can see how the risk factors scale up significantly from credit cards. It's just stated income, whatever, to all the way to a mortgage where we have dedicated departments to verify all of these pieces. And again, there's other risk factors, property type, location, things like that. If you're in Florida, for example, where a lot of insurance companies are pulling out of, then you're going to have a requirement to have a special insurance, make sure you have the flood rider, for example. So, I mean, we can keep going with this example. I think we get the point. This is kind of how banks make a decision. Your big key decisions are going to be, are you approved? What's your credit limit? And what's your APR? And of course, you have the ability to increase your credit limit over time. And, you can even ask for APR decreases if you want. I don't think it's really worth it. Just pay your bill in full and you should be good to go. But overall, guys, that's really, at the highest level, how banks make decisions. It's really just risk decisions, right? So, Lehman who, as they say. But anyways, guys, if you like this one, drop me a thumbs up down below. If you find it particularly interesting, consider subscribing to the channel. Again, we're posting content just like this every single week and right back every Sunday with all the news you can use in the week that was in credit and finance. Of course, every single day over on profitablecontent.com, where you have the latest news stories, bank bonuses, and credit card offers. Put your new skills to the test. Anyways, guys, that's going to do it for this one. As always, thanks so much for watching. I'll talk to you very soon in the next one.